Before we begin, please note that the information in this video is for educational and informational purposes only and is not intended to be a substitute for professional legal or financial advice. We are not lawyers, financial advisors, or insurance agents. The laws and regulations surrounding auto insurance are complex and can change. Always consult with a qualified professional for advice tailored to your specific situation. Imagine you're in a car accident, a devastating one. Your life is changed in an instant. In almost any other state in America, your auto insurance policy has a hard limit on what it will pay for your medical bills. Maybe it's $50,000. Maybe, if you have great coverage, it's $250,000. But once that money runs out, you're on your own. You're relying on your health insurance, your savings, or government programs. But for nearly 50 years in the state of Michigan, that limit didn't exist. It was infinite. If you needed round-the-clock care for the rest of your life, your car insurance paid for it. If you needed your entire house remodeled to accommodate a wheelchair, your car insurance paid for it. A lifetime of unlimited medical care guaranteed. This single unprecedented promise created an insurance system so unique, so expensive, and so fiercely debated that it turned the state into a national anomaly. It spawned a billion-dollar industry, fueled epic political battles, and for decades, forced Michigan drivers to pay the highest car insurance premiums in the entire nation. And even though things have changed, the ghost of that system still haunts every single insurance bill in the state today. So, why is Michigan auto insurance so different from everywhere else? Why have you been paying so much for so long? And what did the massive historic reforms of 2019 actually do to your coverage and your costs? Over the next 10 parts, we are going to pull back the curtain on the most complex and controversial auto insurance system in America. We will dig into the history, the politics, and the money. We'll uncover how a well-intentioned idea from the 1970s spiraled into an economic crisis for millions of drivers. We'll explore the rise of a medical legal machine that profited from the system, and the heart-wrenching stories of the people who depended on it. By the end of this series, you will finally understand the machine. You will know the key players, the secret fee schedules, the catastrophic claims, and exactly what you are paying for every time you write that check to your insurance company. This is the story of Michigan no fault. To understand Michigan, you first have to understand how fundamentally different its approach is. Most states use what's called a tort system, or an at-fault system. It's pretty simple. If someone crashes into you, they are at fault. Their insurance company is responsible for paying for your medical bills and the damage to your car. It's a system based on blame. After a crash, the first question is always, whose fault was it? This often leads to long, drawn-out investigations and lawsuits. Insurance companies fight each other, lawyers get rich, and injured people can wait months, or even years, to get the money they need to recover. Back in the early 1970s, lawmakers across the country saw this as a broken system. It was slow, inefficient, and clogged up the courts. So a new idea emerged: no-fault insurance. And Michigan decided to go all in. In 1973, the state passed the Michigan No-Fault Act, and it flipped the entire concept of car insurance on its head. The new rule was simple. After an accident, it doesn't matter who was at fault. Your own insurance company pays for your medical bills. The other driver's insurance company pays for their medical bills. You take care of you, I take care of me. The goal was to get blame and lawyers out of the equation for most accidents. No more fighting over who ran the red light just to get your doctor bills paid. The money would be paid out quickly, efficiently, directly from your own insurer. This was known as the grand bargain. In exchange for this speedy, guaranteed payment of your economic losses, things like medical expenses and lost wages, Michigan drivers had to give something up. They gave up the right to sue the at-fault driver for pain and suffering, except in cases of very serious injury, permanent disfigurement, or death. So, you couldn't sue someone for $50,000 because the accident gave you anxiety and a sore back for a few months. But in return, you were guaranteed that your real financial losses would be covered. No questions asked. This system has two main parts. The first part deals with damage to cars, and the second, more important part, deals with damage to people. And it's the part that deals with people where Michigan took a radical turn. This coverage is called Personal Injury Protection, or PIP. It's the heart of the no-fault system. PIP is what pays for your medical bills, a portion of your lost wages if you can't work, and replacement services, like hiring someone to mow your lawn or clean your house if your injuries prevent you from doing it yourself. Many states have some form of no-fault and PIP coverage, but their benefits are strictly capped. In Florida, the standard PIP benefit is $10,000. In New York, it's $50,000. But Michigan, in its ambition to create the best safety net in the country, did something no other state dared to do. They made the medical portion of PIP coverage mandatory, and they made it unlimited. It wasn't unlimited for a year. It wasn't unlimited up to $1 million. It was unlimited medical coverage for your entire life. It was, by far, the most generous auto insurance benefit in the world, a gold-plated promise baked into every single policy sold in the state. If a catastrophic accident left you needing a lifetime of care costing $10, $20, or even $50 million, your auto insurance policy was legally required to pay for it. This was a noble, almost utopian idea. It was designed to ensure that no car accident victim would ever go bankrupt because of medical bills. It was a social safety net funded not by taxpayers, but by drivers. For decades, it worked for thousands of catastrophically injured people, providing a level of care that was unimaginable anywhere else. But this promise of unlimited benefits came with a hidden explosive cost. What happens when a system with no limits on care collides with a healthcare industry that has no limits on its prices? What happens when there are no price controls, no fee schedules, and no one to question the bill? You create a perfect storm. A system designed to help people inadvertently created a gold rush, where some hospitals and clinics could charge auto insurers 2, 3, or even 10 times more than they would charge Medicare or a standard health insurer for the exact same procedure. And under the law, the auto insurance companies had no choice but to pay it. This single dynamic, unlimited benefits meeting uncontrolled costs, set the stage for a 50-year war. A war between insurance giants, multi-billion-dollar hospital systems, personal injury lawyers, and the most vulnerable accident victims, with every single Michigan driver caught in the economic crossfire, forced to fund the most expensive auto insurance experiment America has ever seen. To understand this experiment, you have to go back in time. Back before the multi-lane freeways and the endless legal battles. Back to a time when a simple car crash could utterly destroy your life, not just because of the physical injury, but because of the legal system that was supposed to protect you. Before 1973, Michigan, like most of America, operated under what's called a tort system. The word tort is just a fancy legal term for a wrongful act that causes someone harm. In the world of auto insurance, it meant one thing: blame. Everything, and I mean everything, hinged on proving who was at fault. If someone ran a red light and T-boned you, it seems simple, right? They were at fault. You should be covered. But it was never that easy. The tort system was a legal demolition derby. To get a single dollar for your medical bills, your lost wages, or your totaled car, you had to legally prove the other driver was 100% responsible. Not 99%. 100. And you had to do it while fighting their insurance company, a corporate giant with a team of lawyers whose entire job was to prove you were, in fact, at least 1% to blame. Imagine it's 1968. You're a factory worker in Detroit. Let's call you Frank. You're driving home from the plant, and a car swerves into your lane. The crash is bad. You wake up in the hospital with a shattered leg and a concussion. The doctors say you'll be out of work for at least a year, maybe more. Your medical bills start piling up. The first one is for $5,000, a fortune back then. But you're not worried, not at first. The other driver clearly caused the accident. His insurance will pay. But then the letter arrives. The other driver's insurance company denies your claim. Their client, they say, claims you were speeding. They say you had time to swerve. They say you might have been tired after a long shift. Suddenly, you aren't a victim anymore. You're a defendant. To get the money you need to fix your body and feed your family, you have to hire a lawyer. That lawyer takes a third of whatever you might win right off the top. Now you have to find witnesses. You have to sit for depositions where a lawyer you've never met grills you for hours, trying to poke holes in your story. Months turn into a year. Your savings are gone. You're borrowing from family. The hospital is threatening to send your bills to collections. All the while, the insurance company stalls, delays, and offers you a settlement for pennies on the dollar, knowing you're getting more desperate every single day. This wasn't a rare occurrence. This was the system. It was a nightmare lottery. If you were lucky enough to have a clear-cut case with a dozen witnesses, and the other driver had great insurance, you might get the money you needed in a year or two. But what if the other driver had no insurance? You got nothing. What if it was a hit and run? You got nothing. What if you couldn't prove they were 100% at fault? You got nothing. Studies from that era were horrifying. The U.S. Department of Transportation found that in serious injury cases, victims were recovering less than a third of their actual economic losses. The system was clogged with lawsuits over minor fender benders, while families crushed by catastrophic accidents were left bankrupt and alone. It was slow, it was inefficient, and it was profoundly unfair. It rewarded people with minor injuries who could game the system for a quick payout, and it punished the people who needed help the most. The public was furious. The legal community was frustrated. The politicians knew something had to be done. This broken, blame-based system was failing everyone. And out of this crisis, a revolutionary idea began to take hold. An idea that promised to end the courtroom battles, to get money into the hands of injured people quickly, and to treat car accident injuries like a health issue, not a legal one. It was called no-fault insurance. The concept was beautifully simple, almost utopian in its promise. It was a grand bargain offered to every single driver. Here's the deal. After an accident, you no longer have to sue the other driver. You don't have to prove they were at fault. You don't have to fight their insurance company. Instead, your own insurance company would pay for your medical bills and lost wages immediately. It doesn't matter if you caused the crash or if the other guy did. No blame, no fault. Just fast, efficient payment to help you recover. In exchange for this incredible benefit, this guarantee of immediate care, you, the driver, would give up something. You would give up the right to sue the other driver for non-economic damages. Things like pain and suffering. Lawsuits wouldn't be eliminated entirely. You could still sue if the injuries were catastrophic, like a permanent disfigurement or death, but the thousands of small, clog-the-system lawsuits would vanish overnight. The goal was to take the lawyers out of the equation for most accidents, to stop paying for years of legal trench warfare and instead use that money to pay for doctors for rehabilitation, for getting people back on their feet and back to work. It was supposed to be cheaper, faster, and more humane. Many states across the country looked at this idea and adopted their own versions of it in the early 1970s. Florida, New York, Massachusetts, they all created no-fault systems. They put caps on the medical benefits, maybe $10,000 or $50,000, believing that would cover the vast majority of injuries. It was a pragmatic solution to a nationwide problem. But Michigan did something different. The lawmakers in Lansing saw the promise of no fault and decided to take it a step further. They weren't just trying to solve a problem. They were trying to create a true safety net. They wanted to build a system so comprehensive, so powerful, that no person injured in a car crash on a Michigan road would ever have to worry about paying a medical bill ever again. For the rest of their life. They drafted their own no-fault law, which passed in 1973. It contained the same grand bargain. Your own insurance pays your bills, and you give up the right to sue for pain and suffering in most cases. But they added one seemingly small, but monumentally important provision. A promise that no other state dared to make. While other states put a $50,000 cap on medical benefits, Michigan's law required insurance companies to pay for all reasonable and necessary medical care for an accident victim's entire lifetime. There was no dollar limit. There was no time limit. The benefit was, for all intents and purposes, unlimited. It was the most generous, ambitious auto insurance law ever written in the history of the United States. A promise of cradle-to-grave medical care for anyone injured in a car. It was designed to be the perfect system, a shield for every driver. But baked deep into the DNA of that unlimited promise was a fatal flaw. A flaw that would lie dormant for years before interacting with the explosive growth of American healthcare costs, creating a financial monster that would eventually consume the entire system, turning a utopian dream into a statewide financial nightmare. The promise of unlimited was about to be tested in the real world, and no one could possibly imagine the consequences. The problem wasn't the fender benders. It wasn't the broken taillights or the scraped bumpers. The insurance companies could handle those all day long. The real, ticking time bomb at the heart of Michigan's grand experiment was something else entirely. It was the catastrophic claim. Imagine a recent high school graduate. Let's call him Alex. He's 18 years old, driving home from his summer job, dreaming about college in the fall. In one horrific screeching instant, a drunk driver runs a red light and T-bones his small sedan. Alex survives. But that's just the beginning of his story. He has a severe traumatic brain injury and is paralyzed from the waist down. He'll need a ventilator to help him breathe, round-the-clock nursing care, specialized therapies, multiple surgeries, a custom wheelchair, and a home modified for accessibility. And he'll need this care not for a year, not for a decade, but for the rest of his life. A life that modern medicine could now extend for another 50 or 60 years. The cost? Millions. Tens of millions of dollars over his lifetime. Now multiply Alex by hundreds and then thousands of other tragic accidents across the state year after year. A single insurance company, even a large one, couldn't possibly absorb that kind of financial hit repeatedly. If just a few of these multi-million-dollar lifetime claims landed on one company's books, it would go bankrupt. The entire system would collapse. The utopian promise of unlimited for life would be an empty one. Michigan's lawmakers saw this iceberg on the horizon. They knew they had created a promise so immense that no single entity could fulfill it. So, in 1978, they created a backstop, a financial firewall. They created an entity that most Michiganders even today have never heard of, yet it has controlled a massive portion of their auto insurance bills for decades. It's a quasi-public, non-profit association run by a board of insurance executives. It has no public shareholders. Its meetings are held in private. It is one of the most powerful and secretive financial forces in the state. They called it the Michigan Catastrophic Claims Association, or the MCCA. And its job was simple: to pay for the unlimited. Here's how the ingenious and ultimately ruinous system worked. Your insurance company, let's say State Farm or Progressive, was responsible for all of your medical bills up to a certain very high limit. This is called the retention level. Think of it like a super high deductible, but for the insurance company itself. In the early days, this limit was $250,000. So for any given accident, your insurer paid the first $250,000 in medical costs. But the second that bill ticked over to $250,001, the claim was officially catastrophic. At that point, the MCCA stepped in. It would then reimburse the insurance company for every single dollar spent on that person's care, forever. It was a brilliant solution on paper. It socialized the risk. Instead of one company going bankrupt from a handful of terrible accidents, every insurance company operating in Michigan would share the burden of every catastrophic claim in the entire state. But that begs the question: where did the MCCA get its money? It didn't come from the state budget. It didn't come from income taxes. It came directly from you. The MCCA was given the power to levy a special fee, a per-vehicle assessment, on every single insured car, truck, and motorcycle in the state of Michigan. Every year, the actuaries at the MCCA would look at their books. They'd calculate how many people were currently receiving lifetime care, estimate how many new catastrophic claims would happen in the coming year, project future medical costs, and then they'd set the fee. That fee was then passed from the MCCA to the insurance companies, who passed it directly onto the policyholders' bills. It was a mandatory pass-through, a hidden tax on driving. In the beginning, nobody really noticed. In 1978, the first full year of the MCCA fee, it was just $3 per vehicle. For the entire year. $3 for the peace of mind of knowing that if the worst thing imaginable happened, you would be taken care of for life. It was the best deal in the country. For the first decade, the fee stayed incredibly low, bouncing around between $3 and $6. The system seemed to be working perfectly. Michigan had solved the puzzle. It was a model of compassionate, comprehensive care. But beneath the surface, 3 seismic shifts were happening that the original architects of the system had never fully accounted for. First was the relentless, unstoppable beast of medical inflation. The cost of healthcare wasn't just rising with normal inflation. It was exploding. A day in the ICU, a complex surgery, a new medication. The prices for these things were doubling and tripling at a rate far beyond anything else in the economy. The unlimited promise of 1973 was tied to a cost structure that would be unrecognizable by 1993 or 2003. Second was the miracle of modern medicine itself. In the 1970s, a victim of a catastrophic accident like our hypothetical Alex might have only lived for a few years. But with advancements in trauma care, respiratory therapy, and infection control, people were surviving. And not just surviving, but living for decades. This was a profound victory for humanity, but a financial catastrophe for the MCCA. Every person they added to their rolls was a multi-million-dollar liability that could last for half a century. The fund wasn't just paying for new accidents. It was accumulating a vast, permanent, and ever-growing population of patients requiring the most expensive care on Earth. And this led to the third and perhaps most corrosive problem, the blank check. Because the promise was unlimited and for life, and because the MCCA was legally obligated to pay for all reasonable and necessary care, there were virtually no cost controls. None. If a doctor, a hospital, or a home healthcare agency submitted a bill, the MCCA, through the insurance company, had to pay it. There was no fee schedule like you'd find in Medicare or a standard health insurance plan. This created a gold rush. A whole new industry of post-accident care facilities, rehabilitation centers, and home nursing companies sprang up across Michigan, specifically to serve no-fault patients. And why wouldn't they? Their customer had the best insurance on the planet. They could charge rates 2, 3, even 5 times higher than what they could get from any other payer for the exact same service, and they knew the bill would be paid. Attendant care, where family members could be paid to look after their injured loved ones, was a compassionate and vital part of the system. But without oversight, it was also ripe for abuse, with some billing for 24 hours a day, 7 days a week, at inflated hourly rates. The system wasn't just encouraging good care, it was incentivizing astronomical billing. By the early 1990s, the cracks began to show. The once trivial MCCA fee started to creep up. In 1992, it hit $29. A year later, it jumped to $77. By 1995, it broke the symbolic $100 barrier for the first time, hitting $106. Michiganders who had never paid much attention to this line item on their bill started to ask questions. What is this MCCA fee? And why does it keep going up? The quiet, efficient machine designed to be a financial backstop was starting to groan under the weight of its own infinite promise. The 3 ticking time bombs, medical inflation, longer lifespans, and the blank check for providers were all detonating at once. The fee, which had been a few dollars for a decade, had multiplied by over 30 times in just a few short years. And it was just getting started. The dream of unlimited care was colliding with the reality of infinite cost, and Michigan drivers were now on the hook for a bill that had no ceiling. The monster was awake, it was hungry, and it was growing faster than anyone could control. To understand how this monster got so big so fast, you have to look inside its DNA. You have to understand the one critical flaw, the single missing gene in Michigan's no-fault law that turned a noble idea into a financial black hole. That flaw can be summed up in 3 words: no fee schedule. Think about it. When you go to the doctor for a checkup, your health insurance company doesn't just get a bill for one checkup. They have a pre-negotiated contract with the doctor, a schedule of fees that says a standard office visit costs, say $150. Your workers' comp insurance has a fee schedule. Medicare has a fee schedule. These are the rulebooks, the menus with prices, that prevent a hospital from charging you $10,000 for an aspirin. It's the bedrock of how medical billing works in America. Except for decades in Michigan's auto insurance system, that rulebook didn't exist. If you were injured in a car crash, the hospital or clinic that treated you could charge, well, whatever they wanted. They weren't bound by what Medicare paid. They weren't bound by what Blue Cross Blue Shield paid. They could, and often did, charge 2, 3, even 10 times more for the exact same procedure, simply because the bill was being sent to an auto insurer. An MRI that might cost $1,000 under a normal health plan could be billed for $5,000 if it was for a car accident victim. Physical therapy sessions, occupational therapy, rehabilitation services, all of it existed in a wild west of billing with no sheriff in town. This created a bizarre and lucrative 2-tiered medical system. A doctor in Traverse City could treat 2 patients back to back, both with the same broken leg. The first patient, who fell off a ladder, would have their treatment billed according to a strict fee schedule. The second patient, who was injured in a car accident, represented a potential jackpot. Their treatment could be billed at a much, much higher reasonable and customary rate, a vague term that lawyers could spend years arguing over. The incentive was clear. Treating auto accident victims was incredibly profitable. But even that wasn't the main artery of the cost explosion. The real gusher, the one that made Michigan's system truly unique in its expense, was something called attendant care. The idea behind attendant care was once again born from compassion. If someone suffered a catastrophic injury, a brain injury, paralysis, they would need round-the-clock help. They'd need assistance with basic life activities: eating, bathing, getting dressed, managing medication. The law allowed for this care to be provided by family members, not just professional nurses. It meant a spouse, a parent, or a child could stay home to care for their loved one and be compensated for their time. On the surface, it sounds like the most humane, wonderful provision imaginable. But combine this compassionate idea with the no-fee schedule problem, and you create a perfect storm. Suddenly, family members could bill an auto insurance company for providing care to their loved one. And how much could they bill? Well, with no fee schedule, the rates were often set based on what a professional agency would charge, sometimes even more. A spouse could quit their $40,000 a year job to provide care that was then billed to the system at a rate of $20, $30, Or even $40 an hour, 24 hours a day, 7 days a week. Do the math. $25 an hour, 24 hours a day, is $600 a day. That's over $200,000 a year. Tax-free. Paid for by the Michigan Catastrophic Claims Association, which means it was paid for by every single driver in Michigan. Now let's be crystal clear. Many families provided legitimate, necessary, and life-saving care. They sacrificed their lives and careers to help a loved one, and this system allowed them to do that without facing financial ruin. Their stories are real, and their needs are profound. But a system this rich with money and this loose with rules inevitably invites abuse. Stories began to surface of caregivers billing for 24 hours a day while holding down another job, or billing for care while they were on vacation hundreds of miles away, because there was little oversight, and because insurance companies found it was often cheaper to just pay the claims rather than fight a multi-year lawsuit they were likely to lose. The attendant care system ballooned into a cottage industry. It became the single largest driver of catastrophic claim costs, dwarfing even the hospital bills. This combination, unlimited medical coverage, no price controls, and loosely regulated attendant care, created a powerful magnetic pull. It attracted a whole ecosystem of businesses that sprouted up to service this unique market. Specialized rehabilitation clinics opened that only treated auto accident victims because they could charge rates that would be unthinkable anywhere else. Case management companies formed, their entire business model based on coordinating services for a single victim and maximizing the billing potential of their claim. And of course, armies of lawyers on both sides, for the plaintiffs and the insurers, who built entire careers litigating the definition of reasonable and necessary care. A single car accident was no longer just a medical event. It was the birth of a small corporation, with the victim at the center, funded by a guaranteed, unlimited, lifetime revenue stream from the auto insurance system. The goal, for many within this new industry, was not necessarily to get the patient back to their old life, but to secure and manage their new life as a permanent recipient of benefits. And all of this was being funneled back to that one organization in Livonia, Michigan, the MCCA. Every year, their actuaries would look at the lifetime projections for all the new catastrophic claims. They saw the cost of an average claim rising from a few $100,000 to millions. They saw the number of active claims growing. They saw the attendant care bills piling up. And they had only one tool to deal with it. They had to raise the fee. What started as a $3 per year fee in 1978 began to climb. By 1988, it was $26. By 1998, it was just under $30. But then the explosion really began. In 2003, it jumped to $128. By 2013, it was $186 per vehicle per year. This wasn't a tax. It wasn't a luxury. It was a mandatory fee just for the privilege of legally driving a car in Michigan. And it was on top of your regular insurance premium for collision, theft, and liability. Michigan drivers started to feel the squeeze. They were now paying more for their auto insurance than anyone else in the country by a long shot. In Detroit, residents were paying more for their car insurance than their car payment, or even their mortgage. It was becoming an unbearable financial burden. People were angry. They knew they were paying too much, but the system was a black box. They just saw a bill that went up and up and up. They blamed the insurance companies for being greedy. They blamed the lawyers. They blamed the hospitals. And in a way, they were all right. But they weren't blaming the source code. They weren't blaming the fundamental architecture of the system itself. The system wasn't broken. It was working exactly as it was designed. It was a perfect, well-oiled machine for creating infinite cost. And by the early 2000s, this machine had become so large and so powerful, with so many people and industries depending on it for their livelihood, that trying to change it seemed impossible. Any politician who dared suggest putting limits on care, or introducing a fee schedule, was immediately painted as a monster. They were accused of wanting to throw paralyzed car crash victims out on the street. Commercials would run, funded by the trial lawyers and healthcare providers, featuring sympathetic victims in wheelchairs, begging lawmakers not to take away their care. It was the ultimate political third rail. To touch it was to commit career suicide. The system was designed to protect the vulnerable, but it had created a multi-billion-dollar industry that now had a vested interest in keeping things exactly as they were. To change it, you wouldn't just be fighting a law. You'd be fighting an entire economy built on tragedy. And that fight was about to get very, very ugly. The battle lines were drawn in the marble halls of the Michigan State Capitol in Lansing. On one side, you had the insurance giants, massive publicly traded companies with armies of lobbyists and nine-figure marketing budgets. On the other, a powerful and surprisingly unified front, the healthcare industry and the state's trial lawyers. And caught in the crossfire? Every single person who owned a car in the state of Michigan. For decades, this wasn't a fair fight. It was a legislative war of attrition, and one side had all the heavy artillery. Let's break down the battlefield, because understanding the players is the only way to understand why, for 40 years, nothing changed. First, you have the insurance lobby. Their message was simple, consistent, and blasted across every television and radio station in the state. Your rates are high because of fraud and abuse. They painted a picture of a system run amok, with shady clinics and crooked lawyers milking the system for every last penny. They would point to outlier cases, a clinic charging $1,000 for a hot pack, or someone claiming lifetime attendant care for a stub toe. And to be fair, fraud was real. It existed, but it was also the perfect boogeyman. It allowed the insurance industry to deflect any and all questions about their own profits, their own administrative costs, and their own rate-setting practices. Their proposed solution was always the same: we need to cap the medical benefits. We need to put a limit on what we have to pay out. Only then, they promised, would your premiums come down. It was a seductive argument because it offered a simple answer to a complex problem. But then you had the second army, the healthcare providers. And this is where the economy built on tragedy really comes into focus. When Michigan passed its no-fault law, it inadvertently created a golden goose for hospitals, rehabilitation centers, and long-term care facilities. Because the law required reasonable and necessary medical care to be paid for life, it created a payer, the auto insurance company, that couldn't say no and had infinitely deep pockets. Think about it. If you get into a car accident and have Blue Cross Blue Shield, the hospital has a pre-negotiated rate for every single procedure. An MRI might be billed at $1,000. If you have Medicare, that rate is even lower, maybe $600. The hospital accepts this because they want access to the millions of patients those insurers cover. But auto insurance? There were no negotiated rates. There were no fee schedules. The law simply said the charges had to be reasonable. And what's a reasonable charge for a highly specialized brain surgery that just saved a person's life? The hospitals and clinics argued that reasonable was whatever they decided to charge. This led to a phenomenon called cost shifting on an epic scale. That same MRI that Blue Cross paid $1,000 for? An auto insurer could be billed $5,000, $6,000, even $7,000 for the exact same scan, in the exact same machine, performed by the exact same technician. Hospitals created entire wings dedicated to auto accident victims. Specialized rehabilitation centers sprung up across the state, some of them resembling luxury resorts, offering round-the-clock care at a cost of tens of thousands of dollars a month. It was a booming business. For them, any attempt to introduce a fee schedule or cap benefits wasn't just a policy debate. It was an existential threat to their entire business model. So they fought back hard. Their messaging was the emotional counterpoint to the insurer's cold logic. They ran ads featuring wheelchair-bound accident victims, telling heart-wrenching stories of recovery. They put forward the faces of the people who depended on the unlimited system. Their argument was powerful. You can't put a price on a human life. They argued that insurance companies were just trying to fatten their pockets by abandoning the most vulnerable people in their darkest hour. They warned that caps would mean people being kicked out of care facilities, forced onto Medicaid, and becoming a burden to the taxpayers. And they asked every voter a terrifying question. If it were your son or daughter in that hospital bed, wouldn't you want them to have unlimited lifetime care? And standing shoulder to shoulder with the medical industry was the third power player, the Michigan trial lawyers. Their role was a bit more complex. The no-fault system had already taken away their bread and butter, suing for minor injuries and small claims fender benders. But it left a crucial door open. You could still sue the at-fault driver for non-economic damages, meaning pain and suffering, but only if the victim suffered a serious impairment of body function. This created a high-stakes environment. The more severe the injury, the bigger the potential lawsuit. The lawyers, therefore, had a vested interest in a system that provided the absolute maximum level of medical care. Extensive medical records and long-term treatment plans were crucial evidence in court to demonstrate the severity of an injury and justify a multi-million-dollar pain and suffering award. Any reform that capped medical benefits or introduced a fee schedule would indirectly devalue their cases. It would weaken their leverage. So the lawyers and the medical providers formed an unholy alliance. pooling their resources to lobby legislators and fight back against any proposed changes. So you have this three-headed beast guarding the status quo: the insurers, the hospitals, and the lawyers, all with diametrically opposed interests, yet all contributing to the ever-spiraling costs. For a politician in Lansing, trying to fix this was political suicide. No matter what you proposed, two of the three most powerful lobbying forces in the state would immediately declare war on you. If you sided with the insurers and proposed caps, the hospitals and lawyers would blanket your district with ads accusing you of wanting to throw grandmothers out of their wheelchairs. They would bus in accident victims to testify in emotional committee hearings, creating a public relations nightmare. If you sided with the hospitals and lawyers and proposed regulating insurance company profits, the insurance lobby would unleash a torrent of ads claiming you were killing jobs and driving business out of the state, all while your constituents' rates continued to climb. And so, for 40 years nothing happened. Bill after bill was introduced with great fanfare, promising relief to Michigan drivers. And bill after bill died a quiet death in a subcommittee, strangled by lobbyist pressure. The political gridlock was absolute. It was a perfectly balanced, yet completely dysfunctional equilibrium of power. Meanwhile, the human cost of this stalemate was staggering. On one hand, you had stories that seemed to justify the whole system. A young woman named Sarah, T-boned by a drunk driver at 21, left a quadriplegic. Under Michigan's no-fault system, her parents were able to modify their home with ramps and a lift. She received 24/7 attendant care, specialized physical therapy, a custom wheelchair, and a voice-activated computer that allowed her to continue her college education online. Her care cost hundreds of thousands of dollars a year, a sum that would have bankrupted her family in any other state. For Sarah, the system wasn't broken. It was a lifeline. It was the fulfillment of the original promise. But then you have the Jacksons, a family of 4 in Detroit. The husband works at an auto parts plant. The wife is a part-time cashier. They drive a 10-year-old Ford Focus. In 2017, their auto insurance bill was over $400 a month. That's more than their car payment and their utility bills combined. They had perfect driving records. No tickets, no accidents. But they lived in a zip code that insurers had redlined as high risk. They were paying for Sarah's care, and the care of thousands like her. They were paying for the $7,000 MRIs. They were paying for the fraud and the abuse. And they were paying for the profits of the insurance companies and the trial lawyers. Every month they faced an impossible choice: pay the insurance or pay for groceries, risk driving illegally to get to work, or risk not being able to feed their kids. For decades, the powerful stories of people like Sarah won the political debate. The moral argument for unlimited care was simply too strong. But as the premiums climbed from expensive to burdensome to utterly absurd, the silent, desperate anger of millions of families like the Jacksons began to build. It was a slow, simmering rage that the politicians in Lansing had ignored for far too long. The system, once seen as a compassionate safety net, was now viewed by a majority of Michiganders as an oppressive, inescapable tax on their very existence. The political calculus was starting to shift. The fortress of money and influence, which had stood unbreached for nearly half a century, was beginning to show cracks. And the pressure was building to a breaking point. And in 2018, that breaking point arrived in the form of a gubernatorial election that would change everything. The issue of auto insurance wasn't just a talking point. It was a central theme, a promise etched into the very fabric of the campaigns. Gretchen Whitmer, the Democratic candidate, hammered the issue relentlessly, vowing to fix the damn roads, and just as importantly, to tackle the crushing cost of auto insurance. When she won, it wasn't just a victory for her party. It was a mandate from the people of Michigan. The message was clear. The status quo was no longer acceptable. But a mandate is one thing. Turning it into law is another beast entirely. The fortress of the no-fault system, defended by a powerful and well-funded lobby, wasn't going to crumble overnight. The battleground shifted to the state capitol in Lansing, a building that would become the epicenter of one of the most intense legislative fights in modern Michigan history. Imagine the scene. On one side, you have the defenders of the old guard. The insurance industry, with its deep pockets and legions of lobbyists in tailored suits, walking the marble halls with an air of unshakable confidence. Allied with them were powerful healthcare providers and trial attorneys, groups that had, for different reasons, built entire business models around the unique structure of Michigan's unlimited lifetime benefits. They argued with passion and a flood of television ads that any change was an attack on the most vulnerable, They painted vivid pictures of catastrophically injured victims being thrown out of care, left destitute by heartless reforms. Their message was simple and terrifying: don't take away our safety net. On the other side, you had the newly elected governor and a fragile bipartisan coalition of lawmakers from both the House and the Senate. They were armed with public outrage and stacks of data showing Michigan's rates soaring far above every other state. But their greatest asset, their most powerful weapon, walked the same marble halls as the lobbyists. It was the families, the everyday people. They came in wheelchairs and on crutches. They brought photos of loved ones who had been in horrific accidents. But their stories were different. They weren't just victims of car crashes. They were becoming victims of the system designed to protect them. They spoke of the small business owner in the Upper Peninsula paying more for his one delivery truck's insurance than for the truck itself. They spoke of the single mother in Detroit choosing between paying her auto insurance and buying groceries. They were the human face of the statistics, the living embodiment of the pressure that had been building for decades. The legislative chambers became a pressure cooker. The debate wasn't just about dollars and cents. It was a clash of fundamentally different philosophies. At the heart of it all was that one sacred, untouchable concept: unlimited lifetime personal injury protection, or PIP. For nearly 50 years, this was the third rail of Michigan politics. To touch it was to commit political suicide. But now the unthinkable was on the table. The Republican-led legislature, headed by House Speaker Lee Chatfield and Senate Majority Leader Mike Shirkey, saw an opportunity. They had their own ideas for reform, and while they didn't always see eye to eye with the Democratic governor, they shared a common enemy: the status quo. The stage was set for a high-stakes negotiation. The core of the proposed reform was radical choice. For the first time, drivers would be able to choose their level of PIP coverage. Instead of everyone being forced to buy the unlimited Cadillac plan, they could opt for lower levels of coverage, say $500,000 or $250,000. For seniors on Medicare or people with excellent private health insurance that covered auto accidents, there was even an option to opt out of PIP altogether. This was the central pillar of the plan to lower costs. Give people control. Let them buy what they need, not what the law forced upon them. But the opposition screamed, what happens when someone with a $250,000 policy has a $3 million injury? It was a legitimate, terrifying question. The reformers had an answer, but it was complex. They argued that the vast majority of accidents don't result in catastrophic, multi-million-dollar claims. And for those that did, the existing Michigan Catastrophic Claims Association, the MCCA, would still be there, albeit in a reformed capacity. The second major front in this war was cost control. This was the dirty little secret of the old system. Because benefits were unlimited, medical providers had little incentive to control costs. A hospital could charge an auto insurer vastly more for an MRI than they would charge Medicare or a private health insurer for the exact same procedure. It was a blank check, and Michigan drivers were footing the bill. The new legislation proposed a fee schedule, tethering the amount that doctors and hospitals could charge for auto accident-related injuries to a percentage of what Medicare pays. This, as you can imagine, set off a firestorm. The healthcare lobby went into overdrive. They claimed that a fee schedule would put specialized rehabilitation centers out of business, forcing them to turn away car crash victims. They argued that the quality of care would plummet, that Michigan's best-in-the-nation trauma care system would be dismantled. It was another powerful, emotional argument that resonated with lawmakers who were terrified of being blamed for harming accident victims. The negotiations were brutal, often stretching late into the night. Deals were made and then fell apart within hours. The governor would draw a line in the sand, the legislature would draw another. The media reported on every twist and turn. For weeks, it seemed like the entire effort would collapse under its own weight, that the fortress of the old guard was just too strong, its walls too thick. The lobbyists were relentless, applying pressure in public and in private. They funded front groups with reassuring names like the Coalition to Protect Auto No Fault, which blanketed the airwaves with ads featuring sympathetic victims begging lawmakers not to change the law. But the pressure from the other side, the pressure from the voters, was just as intense. Lawmakers' phones rang off the hook. Their inboxes were flooded. And in the hallways, they couldn't escape the faces of their constituents, the ones paying those crippling bills. Then, in the final days of May 2019, a breakthrough. In a marathon session that blurred from day into night and back into day, the key players Whitmer, Chatfield, and Shirkey hammered out a final compromise. They emerged from the back rooms, bleary-eyed but united. They had a deal. It wasn't perfect. Nobody got everything they wanted. The choice in PIP levels was in. The fee schedule for medical providers was in, though it was more generous than some reformers had wanted. A new independent fraud authority was created to crack down on abuse. And critically, the bill mandated significant, specific rate reductions for each of the new coverage levels, forcing insurance companies to pass the savings on to consumers. On May 30, 2019, Governor Gretchen Whitmer, flanked by the Republican leader she had battled for months, sat at a desk on Mackinac Island during a major policy conference and signed the bill into law. It was a moment of stunning bipartisanship in a deeply divided era. For the first time in 46 years, the fundamental structure of Michigan's auto insurance system had been broken open and remade. The fortress had been breached. As the ink dried on that historic piece of legislation, a wave of relief and optimism washed over the state. The promise had been kept. Change had finally come. But as everyone would soon discover, the signing of a law is not the end of the story. It's the beginning of a new one. And the real-world consequences of a few sentences on a piece of paper were about to create a whole new set of winners and losers. For the millions of drivers across Michigan, the summer of 2020 brought a welcome sight. A check in the mail. $400 per vehicle. A direct refund from the Michigan Catastrophic Claims Association. It was tangible proof that the reform was working. And it didn't stop there. For the first time in a generation, auto insurance premiums were actually going down. Some drivers reported saving hundreds, even thousands of dollars a year. The headlines were triumphant. The politicians who championed the bill declared victory. They had promised to lower the highest auto insurance rates in the nation, and by all appearances they had delivered. The system, it seemed, was finally fixed. The grand bargain had paid off. But this grand bargain was struck on a simple, brutal premise. To lower costs for the many, you had to cut costs from the few. And the few in this equation were the roughly 18,000 people in Michigan who had suffered catastrophic, life-altering injuries in car accidents. These were the people for whom the old no-fault system was a literal lifeline. They were quadriplegics, people with severe traumatic brain injuries, individuals who required round-the-clock care just to perform the basic functions of life. Their care was complex, specialized, and incredibly expensive, funded by the system every Michigan driver had paid into for decades. The 2019 reform took a scalpel to that system. But it wasn't a precision instrument, it was more like a chainsaw. The new law introduced a series of medical fee schedules, essentially price controls on what providers could charge for services. For hospitals and doctors, the new rates were set around 200% of what Medicare pays. While a significant cut, it was, for many, manageable. But for a different critical category of care, the post-acute and residential facilities that provided the bulk of long-term care for crash survivors, the law was a death sentence. For them, the new reimbursement rate was slashed to just 55% of what they were charging in 2019. 55%. Let that sink in. Imagine you run a small business that provides highly specialized, 24/7 in-home nursing care for someone on a ventilator. You have nurses, therapists, and aides on your payroll. You have insurance, equipment costs, and overhead. Now imagine the government tells you that, starting next month, your only customer will only pay you 55 cents for every dollar of service you provide. You wouldn't just lose money. You'd go bankrupt almost instantly. There is no business model in the world that can survive a 45% cut in revenue overnight. And that is exactly what began to happen all across Michigan. The law was signed in 2019, but these fee caps didn't take effect until July 1, 2021. For 2 years, the time bomb was ticking. And when it went off, the devastation was immediate and widespread. Letters started arriving at the homes of crash survivors. They came from the home health agencies that had been providing their care, sometimes for decades. The letters were apologetic but firm. Due to the new law, they read, "We can no longer afford to provide services. We will be forced to discharge you as a client." For thousands of families, these letters triggered a level of panic and despair that is hard to comprehend. Consider the story of a man who was paralyzed from the neck down in a car crash 20 years ago. Under the old system, his auto insurance paid for a team of home health aides who managed his ventilator, fed him, bathed him, and moved him to prevent life-threatening bed sores. This care allowed him to live in his own home with his family, gave him dignity. After the reform, his care provider, unable to operate at the new 55% rate, had to pull out. Suddenly, his wife, now in her late 60s, was faced with an impossible choice. quit her job to become his full-time, unpaid, and medically untrained caregiver, or put the love of her life into an institution. This story, with different names and different faces, was repeated in thousands of homes. A young woman with a severe brain injury who had made incredible progress in a specialized residential facility was suddenly being discharged because the facility was closing its doors. A child who needed constant therapy and supervision was losing the support that allowed their parents to hold down jobs. These weren't just line items on a budget. They were lives, families, and futures being systematically dismantled. The safety net that had been promised to them, the one they had paid for through their own insurance premiums, had been yanked away. The providers were in an equally impossible position. These weren't giant, faceless corporations. Many were small, Michigan-based businesses, some founded by families who had a personal connection to this kind of care. They were now forced to lay off thousands of skilled nurses and caregivers and shut down operations. One of the state's largest and most respected residential care providers, a place renowned for its work with brain injury patients, was forced to close multiple facilities, discharging dozens of patients with nowhere else to go. The very infrastructure of care that had been built up over 40 years to serve this specific population was collapsing. And here is the cruelest irony of all. The entire point of the reform was to save money. But was it actually saving money, or just shifting the cost? When a catastrophically injured patient is discharged from a specialized home care provider, they don't simply vanish. They end up in an emergency room, or they get admitted to a hospital, or, if they're lucky, they qualify for Medicaid and get placed in a traditional nursing home. Every one of those options is a catastrophic failure. An emergency room is not equipped for long-term ventilator management. A hospital bed costs exponentially more per day than home-based care. And a standard nursing home lacks the specialized staff and equipment to properly care for a young person with a traumatic brain injury. Furthermore, when these patients are forced onto Medicaid, the cost is no longer borne by auto insurance premiums. It's borne by the taxpayers of Michigan and the United States. The savings for auto insurance companies became a new, massive liability for the public. The cost didn't disappear. It just moved from one ledger to another, and the quality of care plummeted in the process. The champions of the reform argued this was a necessary correction. They claimed the old system was rife with fraud and overbilling by providers who had a blank check. And while there were isolated cases of fraud, no evidence ever suggested it was systemic enough to justify a 45% cut across the board. To the families and providers living through the chaos, this excuse was a slap in the face. They weren't fighting for luxury. They were fighting for survival. They felt abandoned by the state, sacrificed for the sake of a $400 check. But the fight was far from over. The most controversial part of the new law was that it was being applied retroactively. It didn't just apply to people injured after 2019. It applied to everyone, even those injured in the 80s and 90s who had been promised lifetime care under the old law. To them, this was more than just a policy change. It was a broken promise, a violation of a contract. And in America, when you believe a law violates a contract, you don't just protest. You sue. The battle was about to move from the state capitol to the state's highest courts, and the central question was a profound one. Can a government change the rules in the middle of the game and take away a promise it made decades ago? The case that would define this struggle was called Andry versus USAA. It wasn't just a lawsuit, it was a last stand. The plaintiffs were people like Ellen Andry, a woman who became a quadriplegic after a drunk driver hit her car in 2014, and Philip Kruger, who suffered a severe traumatic brain injury in 1990 when a truck ran a red light. For decades, their lives, their stability, their very survival, had been built on the foundation of Michigan's no-fault promise. They had planned their futures around it. Their families had made sacrifices, built their lives around providing care, all with the understanding that the system would be there to support them. Their argument was powerful and, to many, deeply intuitive. It centered on a legal concept called vested rights. The idea is simple. When you entered into that insurance contract years before the 2019 reform, you bought a specific set of benefits. You paid your premiums for a promise of unlimited lifetime care if you were catastrophically injured. That promise, they argued, was a contractual right. It had vested. It belonged to you. The government couldn't just reach back in time and change the terms of a deal that was already made. It felt like a fundamental violation of fairness, like buying a house and then having the government show up 10 years later to say, "Sorry, your 30-year mortgage is now a 15-year mortgage, and your payment is tripling." The law changed. This argument wasn't just about fairness. It was rooted in the U.S. Constitution itself, which contains a contracts clause that limits a state's power to pass laws that interfere with existing contracts. The plaintiffs were essentially saying that the 2019 law, when applied retroactively to them, did exactly that. It impaired the core obligation of their insurance contract, the promise to pay for all reasonable and necessary care. They weren't just fighting for their own care, they were fighting for a principle, that a promise made should be a promise kept, especially when that promise is the only thing standing between you and utter ruin. On the other side stood the state of Michigan and the insurance industry. Their argument was just as forceful, but it came from a completely different legal and philosophical place. They didn't see the no-fault system as a simple private contract between a person and their insurer. They saw it as a public welfare program created by statute. And because the legislature created it, the legislature had the right to change it. This is a concept known as police power, the inherent authority of a government to regulate for the health, safety, and general welfare of its citizens. Their argument was that the old no-fault system, with its uncapped costs, had become a threat to the public welfare. It was driving insurance premiums to astronomical levels, making it impossible for millions of Michiganders to afford to legally drive a car. The reform, they claimed, was a necessary and legitimate exercise of that police power to fix a broken system for the greater good. In their view, your insurance policy was never a fixed, unchangeable promise. It was always subject to the laws of the state of Michigan. And when the law changed in 2019, the terms of your coverage changed with it. They weren't breaking a contract, they were simply enforcing the new law of the land, a law designed to provide relief to the state's 10 million other residents. The stage was set for an epic legal clash. In 2021, the first major decision came down from the Michigan Court of Appeals. In a stunning victory for the crash survivors, the court sided with them. The judges agreed that the 2019 reforms could not be applied retroactively. They ruled that the rights to no-fault benefits vested at the time of the injury. The promise had been made, the catastrophic event had occurred, and the deal was locked in. Applying the new fee schedules and hourly limits to these past victims, the court said, was unconstitutional. For thousands of families, it was a moment of pure, unadulterated relief. Felt like justice had prevailed. The system worked. The courts had protected the most vulnerable from having their lives dismantled. Care agencies that were on the brink of collapse started breathing again. Families who were preparing to bring their loved ones home from specialized facilities, with no idea how they would care for them, felt a wave of hope. The rule of law, it seemed, had held. But the celebration was short-lived. The insurance companies and their allies immediately appealed the decision to the highest court in the state, the Michigan Supreme Court. Everything now hung in the balance. The final word on whether a decades-old promise could be retroactively erased would come from just 7 justices. And in July of 2023, the final word came. In a 5-2 decision, the Michigan Supreme Court reversed the lower court. The victory was snatched away. The hope vanished. The court's majority opinion was a clinical and devastating blow to the crash survivors. They declared that the right to no-fault benefits was not contractual. It was purely statutory. Because the right came from a law written by the legislature, it could be changed by the legislature at any time. The court reasoned that there was nothing in the original 1973 no-fault law that explicitly promised the benefits would never, ever change. Therefore, no permanent, unchangeable right had ever been created. Your insurance policy, they essentially said, was a contract to provide whatever benefits the law required at any given moment. When the law changed, the contract's obligations changed right along with it. The promise you thought you had, the bedrock you built your life on, was never as solid as you believed. It was contingent, subject to the political winds of the legislature. The 2 dissenting justices wrote a blistering response. They argued that the majority's decision unravels the grand bargain of the No-Fault Act and allows for an unjust and inequitable result. They sided with the lower court, believing that once someone was catastrophically injured under the old law, their right to the promised care was locked in. To take it away now, they argued, was a cruel bait and switch. But their view did not carry the day. The majority had spoken. The law was the law. The legal battle was over. And the impact was immediate and catastrophic. The Supreme Court's decision meant that the 45% cut to provider reimbursements and the 56-hour-per-week cap on family-provided care could be fully enforced retroactively. The shield the Court of Appeals had provided was gone. Overnight, the foundations of care for an estimated 18,000 catastrophically injured Michiganders crumbled. Home care agencies, which had been holding on by a thread, began to close their doors for good. They simply could not operate when the state was forcing them to accept reimbursement rates that were often less than half their cost of providing care. This triggered a domino effect. Nurses were laid off, therapists were let go, and the patients, people with spinal cord injuries, severe brain damage, people who require 24/7 skilled nursing care, were suddenly being discharged. Not because they were better, but because there was no one left to care for them. The system designed to be their ultimate safety net was now actively casting them out, leaving families to face an impossible choice. Quit your job to become a full-time, unpaid, and often untrained caregiver, or watch your loved one get sent to a nursing home, a place often ill-equipped to handle their complex needs, where their health would almost certainly decline. The promise was officially, legally, and irrevocably broken. The courts would not save them. Now the question became, would anyone? The silence that followed the Michigan Supreme Court's decision was deafening, but it didn't last long. It was soon replaced by the sound of thousands of phones ringing across the state. These weren't calls of relief or resolution. They were calls of termination. Calls from case managers, their voices heavy with regret, explaining that the funding was gone. Calls to home health agencies, canceling the shifts of nurses and aides who had become like family. Calls to families who had built their entire lives around a system they were promised would always be there, telling them that the promise was now void. For the catastrophically injured, this wasn't a legal debate or a political headline. It was a sudden and brutal eviction from a life of stability, however fragile. Imagine being a young man paralyzed from the neck down in a crash 10 years ago. You rely on a ventilator to breathe and 24/7 skilled nursing care just to stay alive. The no-fault system meant you could live at home, surrounded by family, with a degree of dignity. Your care was complex, but it was covered. Then came the call. Your insurance company, now legally empowered by the 2019 law and the court's decision, informed your home care provider that they would only pay 55% of what they used to. The provider, a small business that can't operate at a 45% loss, had no choice. They had to pull their staff. Suddenly, the ventilator alarms, the feeding tube management, the prevention of life-threatening pressure sores, all of it fell onto the shoulders of your 70-year-old mother. The life-saving medical professionals were replaced by a terrified parent, armed with a few hours of frantic training and a bottomless well of love that could never substitute for professional expertise. This story wasn't an exception. It was the new rule. Across Michigan, a hidden world of highly specialized care began to disintegrate. Residential brain injury clinics, facilities that represented the gold standard of long-term rehabilitation, began to close their doors. These weren't just buildings, they were communities, places where people who had lost everything could slowly, painstakingly, piece their lives back together. They learned to speak again, to walk again, to manage the complex cognitive and emotional fallout of a traumatic brain injury. Now, these sanctuaries were being shuttered. Patients who had made incredible progress were being discharged, often back to families completely unprepared for their needs. The result was predictable and tragic. Rapid regression, medical complications, and a tidal wave of despair. The economic ripple effect was devastating. Thousands of highly skilled nurses, therapists, and caregivers lost their jobs. These were not minimum wage positions. They were careers built on years of specialized training. An entire cottage industry born out of Michigan's unique promise was being systematically dismantled. But the true cost wasn't measured in dollars or jobs. It was measured in declining health, in preventable hospitalizations, and in the quiet desperation of families watching their loved ones fade away. The promise wasn't just broken. It was being ground into dust, and the most vulnerable people in the state were being buried beneath it. But in the face of this collapse, something remarkable began to happen. The grief and fear that had paralyzed so many families began to curdle into a fierce, unyielding anger. These were people who had never been political. They were parents, spouses, and children consumed with the daily, all-encompassing task of caregiving. They didn't have time for protests or legislative hearings. But now they had no choice. The fight for their loved ones' care had become a fight for their life. And so they began to organize. They formed coalitions, launched social media campaigns, and started showing up. They showed up in Lansing, the state capital, their wheelchairs and walkers filling the ornate corridors of power. They held press conferences on the Capitol steps, their voices cracking with emotion as they held up photographs of their sons and daughters, husbands and wives. They put a human face on the cold, sterile language of policy and law. They were no longer legacy claims or cost drivers. They were people. They were families. And they refused to be erased. They told their stories to any reporter who would listen. Stories of veterans who survived combat overseas only to be catastrophically injured by a drunk driver back home, now losing their care. Stories of children who would never walk or talk again, whose parents were now being forced to choose between their job and keeping their child alive. They transformed the debate from one about insurance premiums into one about fundamental human rights. They asked a simple, powerful question. What kind of society are we if we abandon our most vulnerable citizens after promising to care for them for life? This grassroots rebellion created a political firestorm. The politicians who had championed the 2019 reform as a victory for consumers were now confronted with the devastating human consequences of their legislation. The media, once focused on the high cost of insurance, was now running front-page stories about the human wreckage the reform had left in its wake. The public narrative began to shift. The initial celebration of lower premiums was being replaced by a growing sense of unease, a feeling that perhaps the cost of those savings was far too high. In response, some lawmakers began to listen. Bills were introduced in the Michigan House and Senate to create a fix for the fix. The goal was to amend the 2019 law to restore adequate funding for the long-term care of existing catastrophic crash survivors. It seemed like a common-sense solution to a moral crisis, but it was never going to be that simple. The insurance industry and its powerful lobby swung into action. They argued that any change, any increase in payments for legacy claims, would inevitably lead to higher premiums for everyone. They framed the issue as a choice between helping a few thousand people and keeping rates affordable for millions of drivers. They deployed an army of lobbyists, armed with data and campaign contributions, to persuade lawmakers that the 2019 reform was working as intended, and that to alter it would be to betray the voters who wanted lower costs. The battle lines were drawn. On one side, an army of families, armed with their heartbreaking stories and a profound moral argument. On the other, one of the most powerful corporate lobbies in the state, armed with immense financial resources and political influence. The fight played out in committee rooms, where hours of tearful testimony from families would be followed by slick presentations from insurance executives. It played out in the media, with dueling op-eds and advertising campaigns. And while the political battle raged, the clock was ticking for the injured. Every day of legislative inaction meant another patient losing care, another family caregiver reaching their breaking point, another specialized facility closing its doors for good. The very infrastructure of care that had taken decades to build was being eroded, and it was unclear if it could ever be rebuilt. The state had reached a stalemate. The courts had declared the law constitutional, washing their hands of the matter. The only path forward was a legislative one, a path blocked by a political and financial war. The system had been broken by a law, upheld by the courts, and now the only people who could fix it were the very same politicians who had created the crisis. It was an impossible fight, against impossible odds. And for thousands of Michigan families, time was running out. And so the fight began. Not in a courtroom with lawyers and judges, but in the court of public opinion and in the marble halls of the state capitol. It was a battle waged not by corporations with deep pockets, but by ordinary people thrust into extraordinary circumstances. It was a coalition of the broken, the grieving and the devoted, mothers who had become round-the-clock nurses, fathers who had modified their homes for wheelchairs, and the survivors themselves, people whose lives had been forever altered by a split second of violence on a Michigan road. Imagine the scene in Lansing. Day after day, families would make the pilgrimage. They came from the Upper Peninsula, from Detroit, from Grand Rapids. They filled the committee rooms and lined the hallways. This wasn't the slick, professional lobbying the politicians were used to. This was raw, painful, and deeply personal. There were people on gurneys, tethered to ventilators, their eyes pleading with lawmakers who struggled to look at them. There were parents holding up oversized photos of their children who were once vibrant and whole, now trapped in bodies that no longer obeyed their commands. They told their stories one by one, their voices cracking with emotion. They spoke of the progress their loved ones had made through years of grueling specialized therapy. A first word relearned, a slight movement in a finger, the ability to swallow on their own. These were not small victories, they were mountains moved. And now they explained it was all about to be taken away. Their care providers, the small family-run businesses that had become extensions of their own families, were sending letters of closure. They couldn't survive on 55 cents on the dollar. The math was brutal, and it was unforgiving. This wasn't an abstract debate about fee schedules. This was about a young man, a former high school football star, whose 24/7 respiratory care was about to be cut, effectively handing him a death sentence. It was about a woman, a mother of 3, who suffered a catastrophic brain injury, and whose specialized cognitive therapy was the only thing allowing her to recognize her own children. Her facility was shutting down in 30 days. Where would she go? The answer was a generic nursing home, a place utterly unequipped to handle her complex needs, a place where she would inevitably decline, losing every single hard-won piece of her recovery. The families were David, and they were facing a Goliath of immense power. The insurance industry and its allies had spent millions of dollars to get this law passed, and they would spend millions more to protect it. They deployed an army of lobbyists who framed the debate in the cold, clean language of economics. They argued that the old system was unsustainable, rife with fraud, and the cause of Michigan's high premiums. The 2019 reform, they claimed, was a necessary correction, a bold move to provide relief to millions of hardworking drivers. It was a brutally effective message. For every heart-wrenching story a family told, the insurance lobby had a counter-narrative about saving the average citizen money on their car insurance. They pitted neighbor against neighbor. The debate became, are you willing to pay a little more to provide unlimited lifetime care for that one person in 1,000 who might need it? Or would you rather have that $150 back in your pocket right now? A price tag was placed on compassion. A value was assigned to human dignity. And for many, the allure of immediate savings was too powerful to ignore. Lawmakers were caught in a political vice. Behind one door, they had a family pleading for the life of their child. Behind the other, they had a powerful industry lobbyist reminding them of campaign contributions and the political consequences of raising insurance rates. The families organized rallies on the Capitol lawn, their numbers swelling into the hundreds, then thousands. Their signs weren't printed by a political action committee. They were handwritten on poster board, with pictures of their loved ones taped to the front. "Don't kill my mom," one read. "A promise is a promise," said another. The media began to pay attention. Local news channels ran devastating segments, contrasting the talking points of politicians with the grim reality faced by families. Newspapers published editorials calling for a fix. A groundswell of public sympathy began to build, but the political will in the legislature remained frozen. The leadership, who had championed the reform as their signature achievement, refused to admit it had created a humanitarian crisis. To do so would be to admit failure. But the families were relentless. They learned the legislative process. They memorized the names of committee chairs. They testified, they called, they wrote, they showed up. They refused to be invisible. They forced the state to confront the human consequences of its own laws. And after months and months of relentless, exhausting pressure, a small crack appeared in the political wall. It wasn't the full repeal they had prayed for. It wasn't a restoration of the sacred promise. But it was something. A modest, bipartisan bill was introduced. It didn't eliminate the 45% cut, but it did create a new tiered fee schedule, offering slightly higher reimbursement rates for certain highly specialized services, the very services that were most at risk. It was a complex, imperfect solution. It was a band-aid on a gaping wound. For a small number of providers, it was just enough to keep their doors open. For a few thousand patients, it meant their care would continue at least for a while longer. But for the vast majority, it was too little, too late. Today, the landscape of catastrophic care in Michigan is permanently scarred. The vibrant ecosystem of specialized rehabilitation centers and residential homes, once considered the gold standard in the entire country, has been decimated. Hundreds of small businesses have closed forever. Thousands of highly skilled nurses and therapists have been laid off or have left the state, taking their irreplaceable expertise with them. Survivors who were once living in supportive, community-based homes, making incredible progress, have been forced into institutional nursing homes, where their conditions have tragically deteriorated. Others have been sent home, where the immense burden of their 24/7 care has fallen on aging parents or overwhelmed spouses, pushing families to their physical, emotional, and financial breaking point. The system that was designed to protect them, to give them a chance at a meaningful life, has been largely dismantled. And the promised savings? For many Michiganders, those initial rate decreases have been erased by inflation and subsequent rate hikes, leaving them with little to show for the sacrifice. So we come back to our original question. Why is Michigan auto insurance so unique? It's unique because it represents both the breathtaking ambition of a compassionate ideal and the profound tragedy of its unraveling. It was a system born from a powerful humane promise. If a car crash on our roads deals you the worst possible hand, we as a society will be your safety net. We will care for you. For life. It was a system that, for all its flaws, prioritized human life over corporate profit. The battle over its fate was never truly about actuarial tables or controlling costs. It was a battle of philosophies. It forces us to ask a fundamental question. Is the primary goal of our society to lower costs for the many, even if it means abandoning the few who need us most? Or is the true measure of our civilization found in how we treat our most vulnerable members, in our moments of greatest trial? Michigan made its choice. It traded a world-class system of care for the promise of affordability. In doing so, it became a living experiment, a cautionary tale for the entire country. And it leaves us with a final haunting question, one that extends far beyond the borders of a single state. It's a question for all of us. What is the true cost of a promise? And what is the price we are willing to pay when that promise is broken?